Finally, the Fed did it. The US Central Bank on Wednesday delivered the quarter-point rise in interest rates that we've all been waiting for. Here in Asia, markets seem to have taken it in their stride. But a quarter-point rise in interest rates and the ones that follow that have got long-reaching consequences for markets in Asia. Here with me to talk about it is Fred Neumann, co-head of Asian economics for HSBC. Fred, emerging markets are expected to suffer when the Fed raises interest rates, but today we've seen a rally. What gives?
Well, it's two things really. Finally, we got some certainty, right? We were waiting for this rate hike and there was uncertainty, are they going to do it or not? Even though it looked very likely, finally we know. And that certainty is always positive for markets, and so you see a bit of relief coming through. The second thing is that the Fed signaled it would move very gradually next year. So we have a dovish hike. That is, the Fed reassured it's not going to slam the brakes, and investors like that because they're worried about fast rising interest rates.
In the slightly longer term though, the thinking is still that US rate rises are bad for emerging markets. Is it really as simple, in Asia particularly, as yes, no, good, bad?
Not quite. So one thing is, you could say that if the Fed hikes interest rates, it really signals a stronger U.S. economy. And that ultimately for economies that are very dependent on the U.S. is actually a positive thing. So if you think about Korea, for example, big exporter to the U.S., to the extent that Fed rate hikes signal the Fed is on a strengthening path, that's positive. But make no mistake, other economies in Asia where we see leverage rise very sharply will suffer from higher U.S. interest rates. Because if leverage becomes more expensive, and that's the fuel of your economy, that's bound to slow.
Which ones would you say are most at risk then? Which economies?
Well, in terms of the biggest rise in leverage that we've seen in Asia, you've seen a particular sharp rise in places like Hong Kong, Singapore. Malaysia stands out as another economy where debt has increased more rapidly than elsewhere. Even in India, debt is still reasonably high, leverage is fairly high, and the country is dependent on capital inflows. And so Indonesia is also in that kind of bracket of countries that rely on capital inflows and therefore more sensitive to US dollar rates.
Now, we have another issue rising here in Asia because you have a tighter Fed on one side, and yet we've still got China and Japan both easing policy. What does that mean for the rest of Asia, which feels kind of stuck in the middle?
It is stuck in the middle a little bit, and we are, dollar rates still matter for Asia. For most of Asia and for emerging markets in general, it is US dollar rates that really set the tone. But to the extent that the PBOC and the BOJ are easing, it helps to cushion the blow from the Fed. So it's not as if we see tightening all around. We see a bit of Fed tightening, partly offset by the BOJ and the PBOC. So it's not going to be this bigger headwind, as if you will, than it otherwise would be if just the Fed was tightening and everybody else joined the Fed in tightening as well.
Now, the problem I'm worried about most is that the Fed's forecasts still say about 100 basis points of interest rate rises in the next year. The market's priced in just about half of that. How does that expectations gap get matched? How does that disappear?
That's going to be the big question 2016 and 2017, the gap between what the Fed says it will do and what investors say the Fed is going to do. And how it gets resolved is going to be a key question. Now, the market is saying the Fed is unrealistic. It's too optimistic. It will cut back its expectations. And in fact, over the last few years, the market has been more correct than the Fed has been. The Fed had to adjust its own projections, and so we still think that the Fed is slightly too optimistic. But make no mistake, if the Fed is right, and they will hike interest rates as they say, you're going to see much more volatility in financial markets, particularly in emerging markets, because it's not yet priced in.
How are we going to see that volatility, or how might we see that volatility in Asia? Are you thinking about a currency shock, for example?
Yeah, so foreign exchange is sort of the first line of defense, if you will. That's where the first pressures begin to emerge. And we saw already a big adjustment in foreign exchange this summer in Asia, partly because the market was positioning for the Fed rate hike we saw yesterday. Now, if we get more rate hikes, it's likely that FX will see the initial ripple effects. And once the foreign exchange adjusts, then other asset classes tend to also reprice, and then it ripples on to fixed income and equities, etc. But it's really the FX part where you see most of the volatility come through.
After the Fed has done this, what do you think the biggest downside risk is for emerging markets in Asia in the next year?
all eyes are on China. So, the Fed is out of the way. We're fairly comfortable about the Fed only hiking 2 times or so next year, which Asia can live with. The big risk is China, because China is the engine that drives demand in Asia. So if China slows down, it means trade will continue to cool off, less tourists coming out of China, etc. And that is a big risk for 2016. So we depend as much on China nowadays as we are in the US. And if China buckles, we're going to feel the effects across the region.
Fred Neumann, thank you very much.
Thank you.